So welcome all to the MFRC's Financial Basics workshops with Martin Corrett and Mark Lee of SISIP. Thank you both for being here tonight and presenting to us and finishing off this series. And we will look forward to your presentation on savings and investment.
Thank you. Good evening, everyone. Thank you for attending this evening's session. So again, I'm Martin Corrett, financial counselor with SISIP, and we also have Mark Lee joining us this evening, who will be touching on more specific SISIP service per se. So we'll go ahead and jump into the meat of things. Tonight, we get to talk about saving and investing, and we're also going to talk about fraud. So things we're going to learn or talk about. So how to invest your money, how to make your money work for you, creating a financial plan, how to reach your goals and how to create goals. And again, just a reminder on fraud, things to be careful, just to avoid some of those scenarios as well. So some of the benefits of all this, again, is taking control of your financial future, achieve your life goals, provide for yourself and your family, just being a smarter consumer and help reduce financial stress. Sleepless night is just but one of them. So again, it is important to look at. So saving and investing. Building wealth is like filling a sink with water. You turn on the tap and plug the sink. The stronger the stream of water from the tap, the faster the sink fills. However, if the plug leaks, the water drains out. The sink fills fastest when the tap is on full and the drain is plugged or has a slow leak. It's the same with wealth building. You accumulate saving most quickly when you maximize your earnings and limit your spending. So a whole lot of words, which basically is the secret to saving money, which nobody ever likes it when I tell them the secret to save money, but it's a rather simple one. Unfortunately, the secret to saving money is not spending it. It's that simple. It comes down to choice of not spending money to be able to create some savings in a lot of cases. And then from there, there's the investment part on how to make that money grow. But it really starts with those first initial choices of the secret to saving the money is to not spend it, basically. So this is what this says. So some of the reasons to save for the future, well, to feel more secure and in control, be prepared for emergency, again, reduces stress and conflict. Spend with less guilt or fear and afford major purchases. So again, if we have a large purchase, could be furniture, appliances, repairs, when we have the money to pay for these things, it's a lot less stressful. We're not adding a monthly payment or anything. We just have the money to pay for it. It makes it a lot easier as well. Gives us an opportunity to pay off debt and avoid new ones, and all the way to eventually retiring comfortably. So definitely a lot of very good reasons to put money aside and save. And it's all about finding a ways to do it that works well for you and to do it in a smart way. Which brings us then to creating some financial goals. So when we're creating financial goals, it's important to be specific. So we're going to talk about setting dollar amounts and deadlines, how to break down those goals into smaller ones, and writing things down. Always important to write things down, because when we write them down, now we're accountable for it, we're able to keep track of it as well. So it's always a good idea to write those financial goals down. So if I say, I'm going to get rid of debt and save money for a rainy day, well, that sounds good, but it's pretty meaningless. There's no numbers, there's no tracking, there's no deadline. You know, I always say this is just, what we tell our parents to make them feel better. Well, but it really doesn't get us anywhere. Now, if I say I'm going to eliminate credit card debt of $1,600 and build an emergency fund of $2,000 by saving at least $3,600 by X date, that's a specific goal there. So we know we have dollar amounts, we know exactly what we're supposed to save, and we have a timeline of by when. Now, all of this always comes back to our budget, though. So we've talked in our first presentation about budgeting, tracking expenses. So that's really our first step, because I can create this goal and have all the important items, dollar amounts and deadlines, but then I also need to be able to relate it to my budget. So if my budget says I can only save $200 a month, well, then this goal is not going to work. I need to make adjustments either on the timeline, the dollar amounts, or make changes in my budget so I can save more. So it always relates back to your budget for anything that we do. But again, big numbers are scary, and that's just human nature. If I say I need to save $2,600 this year, most of us feel like, oh, how am I going to do that? So if we break those goals down, again, it helps us with the psychology behind it of, it's hard for me to save $200, but I can save $100 every 2 weeks. So again, we're all saying the exact same thing. So it's breaking down those goals. So as the example shows here, if you save $200 a month or $100 every pay, that equals saving $2,600 by the end of the year. So it all means the same things, but breaking those goals down help us feel like they're more achievable when in reality they are all the way along. So when it comes to savings, it's very important to make those savings automatic. We're going to talk about paying yourself first, and growing those savings. So we talk about emergency funds, for example, the first one, and that's always a big one. A lot of people talk about, emergency funds in case there's something, but nobody ever really tells you what that amount is. So again, it comes back to our budget. So once we have a good established budget, we know what our cost of living is. So when we talk emergency funds, typically we're looking at 2 to 3 months worth of our cost of living. So whatever your cost of living is, if you have 2 to 3 times that amount in accessible savings, means if anything should happen, illness, loss of employment or something like that, typically that 3 months of savings give you enough time to then get certain benefits to kick in and get you back on your feet. So that's the general guideline when we talk about emergency savings, is 2 to 3 months of cost of living. But that is your cost of living, and everyone's is a little bit different. So making savings automatic is definitely the way to do it. Most people, if every month you need to take money from one account, switch it to the other, most of us forget about it. We spend the money, something comes up. And again, it's human nature. Now, some people are really good and diligent about it, but setting up automatic transfers is always the best way to do it. So again, you can do this yourself. You can go to your bank, have them set it up, or if you're doing investments through SISIP, again, you can talk with one of our financial planner and they can assist with that. So it is always the best way to do it. So looking at saving 5 to 10% of our pay, we had talked in our first presentation again that average percentage saving for Canadians right now is about 5%. And we're saying that aiming for a 10% is definitely a good number in this day and age. So someone earning $2,000 a month after tax at 5% would be $100 a month or $50 every pay, which again will get you that $1,200 a year. 10%, $200 a month or $100 every pay. Again, at that point, saving you $2,400 a year. We had talked in our previous presentation as well about extra money. So things like gifts, tax refund, GST checks, those types of things. Again, that income is not part of your budget. So that in theory is always a great opportunity to give your savings a bit of a jump start. So extra money that's not accounted for anything gives you that chance. Now, it's also an opportunity to treat yourself. There's nothing wrong with that either. But again, it comes down to what is your priority, what are your goals, and what are you trying to achieve to help you make that kind of decision as far as figuring out what to do with that extra money. So a big one, RSP, that I'm going to talk about slightly, and Mark will talk a little bit more about it as well. As we know, an RSP is a long-term investment really meant for retirement, and it really is a time game. So the earlier we start, the better. So an example here with Amy and Amanda. So Amy started saving into an RSP at the age of 20, putting $1,000 every year, and she did this till the age of 34. So at that time, she had saved up $15,000. Amanda started at the age of 30. She put in the same $1,000 a year into her RSP, but did this till the age of 64. So by that time, she had saved up $35,000. So this sounds really good for Amanda, but because Amy actually started 10 years earlier, because our RSP are compound interest, at the age of 65, Amy would actually have more in her RSP savings at 141,000. So that's where the time game comes into play. So RSPs have a lot of great advantages. So again, one meant for retirement. I always kind of warn to not overinvest in an RSP. And what I mean by that is when you put into an RSP, you can take the money out, but then it becomes income and it's taxable. So it's not a good way to put money aside thinking, well, I can take it out if I need it. it does come with some complications. So you definitely want to diversify a little bit in some of those savings. One of the other advantage of the RSP contributions is, again, it helps you save on your taxes, personal income taxes. So it does become a deduction there. And the other advantage is if you are a first-time home buyer, you can borrow from your RSP at no penalty up to $15,000 towards the down payment of a home. Again, this is for new home buyers only. Now, you do need to repay that $15,000 that you've withdrawn, and you need to basically pay it back $1,000 a year over the next 15 years. So again, not only are you saving for your retirement for an RSP, but you're potentially also helping yourself save towards the purchase of a home if you're a new home buyer. So definitely some good benefits there. So when we talk about saving and investment, so first we talked about, our budget, we've identified surplus. So now we're setting up some savings. And there's 4 basic type when we start taking about investing. So our first step, is our basic savings account, tax-free savings account, GIC, such are very standard saving methods that are known by most people. And it's where most of us start, right? With just either a savings account, and now the tax-free saving account is used a lot for that by a lot of people because we don't have to pay taxes on any capital gain on a tax-free savings account. So it's the typical place for most of us to start. But from there, there's other opportunities. So then we start looking into shares and companies. So talking about stocks, mutual funds, which again comes with a different level of risk. Then we can look at property, real estate, art, precious metals, and last but not least, direct investment into the business. So these are the 4 major investment types that are categorized. And again, each one of them comes with their own sense of risk and complexity. So a lot of times people will work with a financial advisor when it comes to do an investment, because it can be a complicated world, especially if you're not part of it. So there is, as we all know, open market. This is a service that most banks offer. It's also a service that's available in the private sector where you can work with financial advisors. And as CAF members, obviously, you have SISIP that offers the service. And then I'll let Mark talk a little bit more about the SISIP specific options when it comes to this service. But when we're looking at the open market, it's very important to not be afraid to ask questions when you're working with any financial advisor. Again, it's a level of comfort. You're looking to trust someone with your money, so you want to get that comfort level. So don't be afraid to ask questions, their background, experience, track record, just get a feel from where they are. If they're working with a firm, or is the firm registered with Securities Commission? Ask them what kind of service do they offer? Advice only? Do they sell products? Do they build financial plans? What products they offer? Again, that can vary quite a bit. Again, where we live can impact that as well. So I reside in a rural area, so even our local banks, when it comes to their financial advisors, the number of products they have to offer is more limited than what's offered in Ottawa, for example, where a larger branch tends to have more products available. So again, very good questions to ask any financial advisor you work with. How they get paid can become important as well. Unfortunately, in the market, there's financial advisors that are definitely paid on commission or get extra by selling certain products. So unfortunately for them, that takes a little bit the focus off of you, because now, depending on what product they sell, they also make more money. So now it's not really necessarily just about you. And again, it is fair for you to know that. And then how do they work with their clients? They come to your home, go to their office. It varies for each type of financial advisor and companies. So looking for the service that will help work for you. And as well, don't be afraid to ask for references. Again, people you can talk to and how happy are they with their service and things like that. So it's about creating a comfort level, so to make sure that you're working with the right person. So when it comes to investing, really, we often talk about the 3 no's. So it's about knowing yourself. So your investment goals, what are you trying to achieve? Is it short-term, medium, or long-term? Or you're looking for retirement, buying a home and things like that. So it's identifying that financial goal. Then your timeline, what type of timeline are we working with? So is this a long-term, again, short or medium-term goal? And then finally, your risk tolerance. And the risk tolerance is a big one because the right investments for you should make you feel good. And if your investments are stressing you out, that probably means that you don't have the right type of investments. And everyone's a little bit different when it comes to that. Some people are very happy with a lower return investment, knowing there's basically very low risk. It's guaranteed. Okay, I'm only going to get 3% by the end of the year, but that 3% is guaranteed. I'm not going to lose my investment, and it's very safe. Versus other people are very open to risk, when we start looking at things like, market and stock trades, where I'm going to invest some money, I've got the potential to make a lot, but I also have the potential to lose it all. And some people are okay with that. And some people lie somewhere in the middle, where they want some security, but are willing to take a little bit of risk. So that always becomes very, very important when you're talking about investment, is according to you, the member, what is your risk tolerance, to make sure that you're offered the right products based on your personality type and your goals and your timelines. So there's a lot of different quizzes available. Again, good financial planners know which questions to ask to figure out what kind of investor you are, to then be able to offer you the right products. So that is always very, very important. So tax-free savings account, again, we talked about it. So what that is basically what I like to call a glorified savings account. The real benefit there is if, again, any capital gains you make in that tax-free savings account is non-taxable, which is good. Versus if you're letting a lot of money just sit in a regular savings account, you're still making a little bit of interest, but then at the end of the year, you have to pay taxes on that interest, which kind of counters most of the gain that you've done. So we've talked about retirement savings plans, so RSPs. So again, defers paying income tax until retirement, creates some additional funds as well for your retirement. There's also a registered education saving plan, so RESP. So that one is putting money aside to help pay for post-secondary education for children. There's no tax benefit when it comes to that program, but the benefit is, depending on household income, every year when you file your taxes, the government does have top-up programs where they'll contribute up to 20% of your contribution on top of what you've put in. So therefore, it helps those funds grow as well. And last but not least, there's the Registered Disability Savings Plan, so RDSP as commonly referred. That plan is very similar to an RESP, except this one is for someone with a disability. So it could be, a child or a family member or whatever, someone that has a disability. So that's, again, a way where you can put money aside into this account to help take care of this individual when the caretakers are no longer available. And the government also does match ups as well. And there are certain restrictions on how the funds can be used, but then that's a little bit more precise, so we can supply some of that information on the need basis for sure, absolutely. So these are the most common registered plans available here. So your tax-free savings, RSP, RESP, and RDSP. So which brings us into financial planning. So we've talked a lot about budgeting. We talked about it in the previous presentations, the first one, the second one. Again, this one, we talked about our budget. But a financial plan is something a little bit different, and it's not to be confused with a budget. So again, a budget doesn't set out any goals. It shows current income and expenses only. So it's a snapshot of what's happening with our money right now. Doesn't include present or future asset, doesn't include debt or loans that might be needed to achieve goals, and it doesn't include steps to be taken. It is truly a snapshot of how much is coming in and where is it going. When we talk about a financial plan, that's a little bit different. Financial plan states a goal, normally in the future. It can be short-term, medium, long-term. You can have financial plans for different goals as well. but it will show future expected income and expenses at that time. So if, let's say, our financial plan is to buy a home, and let's say in 10 years from now, so got someone just starting out. So in 10 years from now, what do we expect the income to be based on either education, career path that is expected and things like that. So now we're more or less building a futuristic budget of what we are expecting to happen. Shows how those expenses are going to be distributed. So that futuristic budget shows potential investment and saving that we think we're going to have. So again, creating that plan of, okay, I want to put some money aside. Here's what I'm planning to do. Here's the type of growth I can expect from that. We'll show loans that are required. So if we're talking about home buying, then we're talking about a mortgage. So then what kind of amount are we thinking about borrowing? What are going to be the payments? What do we think interest rates are going to be? And then shows steps to be taken. And it's really, as detailed as you want to make it. So again, we're talking about home buying. If you are early in your career, all right, you're just getting your first posting, or you're looking into some training, step one to get you a posting, to get you the next promotion, and so on. So it's trying to figure out that career path for yourself at the same time. So all of this is a lot of, here's what I think. Absolutely. But when we do that, now we're starting to write things down and put it on paper, and it helps us guide us to get where we want to be. Because we all know that life happens along the way as well, and that's absolutely normal. So when we create a financial plan, it's not something we create and that's just done. A financial plan is a living plan. It's something that should be reviewed at least once a year, just to see where are we in accordance to our plan, so we can then make adjustments. Maybe you got a promotion quicker than you thought, so the income came up quicker than expected. So maybe our 10-year plan is now a 8-year plan. Or again, along the way, maybe you were hoping for a certain position or a certain promotion that didn't quite happen. So now we were at 8 years, maybe we're back up to 9 years. So it is a living plan that simply helps you guide you through how to get where you want to be. Now, on the general market, financial planners can absolutely do financial plans for you. On average, they charge about $800 to start to create some of these plans, again, depending on who you work with. And really, these are all things that you could do, absolutely. Again, online, you can Google personal financial plans. There's a lot of different templates available to help you through that process. And I have a few templates here myself that I'm happy to share. But a financial plan can help you with things like minimizing taxes, cover insurance needs, buying a home, paying it off quicker, funding education for your children, again, optimizing benefits, save and plan for retirement, fund long-term health issues, care for elderly parents, all the way to estate planning. So a financial plan can really help an individual plan out your financial future of how to get things in line properly. So definitely a lot of things. Here's a quick example that's available that I have. It's kind of a simple walkthrough to make us think about, the things we don't necessarily think about because we've never done this. So first we need to figure out what's the goal. And then it'll work us through assets and debt and savings to figure out, what that looks like. Expected income, how that change going to be. Expected expenses, so that's that futuristic budget that we're starting to create to think where things might be. Again, figuring out our expenses. Do I need any additional incomes, investment returns? And again, asking ourselves some of these questions. So this is just a template to help guide through this creation of a financial plan. This is a very basic one, absolutely. Like I said, there's other ones available through different methods that we can definitely assist with. So we've talked a little bit in general about the basic types of investments that are the 4 types of investments, how to start creating savings with first having that good budget, making some choices to have surplus income, putting some money into savings account to start growing. The only amount of saving that is a bad number is 0. So anything above 0 is good. Some people think that when we talk about saving and investments, we're talking about thousands of dollars, but everyone starts somewhere. And if right now it's putting $20 a month into a TFSA every month, then that's what it is. It's 20 more than what was being put before. But over the years, if that continues and continues, that amount continues to grow. And eventually now, no, I got a couple thousand. Now maybe I can start looking in different type of investment because I don't really need this money for anything. And I can make that grow a little bit faster. And this is definitely where the investment piece comes into play as well. And that's definitely where, SISIP is here to assist you for that piece. So now I will let Mark talk a little bit more about the services offered by SISIP when it comes to saving and investment. So Mark, I will switch it over to you.
All right, excellent. Thanks, Martin. Let me just take control on the screen. Okay. Quest control. All right.
Have you got it there, Mark?
Yeah, I'm trying to
Great.
request control on the Zoom. I'm not sure who is it going to.
Me, I've set it up so you should be able to, everybody who's participating should be able to share a screen.
Yeah, I gave you control, Mark, so you should have it now. Or let me try that.
Oh, maybe you need to turn yours off, Martin. I wonder.
Okay, that's fine.
Okay.
I don't think when I click something is happening. So I guess Martin, you can just click along.
Sure.
Okay, sounds good. All right, thank you so much. All right, so my name is Mark Lee. I'm the financial planner at Denison Armory in Toronto. I serve the Southwestern Ontario, so everything from, say, Newmarket down to St. Catharines, all the way from Windsor, all the way to Bowmanville, right? So that whole region kind of falls under me. So I deal with primarily in terms of insurance, life insurance, and on the investment side. So the main focus really, the two topics that we would talk about is in terms of first is in terms of life insurance, different type of insurance products that is available through SISIP. Then we're going to touch a bit about RSPs and TFSAs. So first of all, when you take a look at life insurance, we always take a look from the perspective of need in terms of why do you need a life insurance, right? So if your need is more of a temporary in nature, so something like if you're looking to cover something like a mortgage, car loans, line of credits, those are more of a temporary need. Hence, you get a temporary life insurance to cover it. Whereas if your need is something permanent, so permanent need would be something in terms of, let's say, final expenses, if you want to leave behind some kind of an estate, legacy. So that's more of a permanent need because that need is always going to be there. Hence, you get a permanent life insurance to cover it. So first off, the screen, what you're seeing on the screen right now is a temporary insurance that is available to CF members and spouses. Now, the names for the temporary insurance is different, but the features and benefits is exactly the same, right? So if you look at the first one, the OGTI is for Rec Force members, the RTIP is for the Reserve Force, and if you become a release member, then it's called the IRM. Now, when you talk about insurance, again, we don't just take a look at a random number that you come up with, hey, you know what, I need $100,000. We always go through an insurance need analysis, which takes a look at what all your existing income is, what your existing assets versus your liabilities, and take a look at how much insurance you actually need, and not just a number coming out from thin air, right? Going on to the next slide. Few features on here. So once again, we're still looking at the temporary insurance, which is available. So in terms of the amounts, you can go up to $1.2 million for member and spouses. If you're single with no dependents, you can go up to a maximum of $250,000. And the term insurance that we have, it automatically covers the dependent child. So dependent child in this situation is a child who is under the age of 18, or if they're going to school full-time till the age of 25. There's also accidental dismemberment benefit, and there's also advanced benefit. So advanced benefit, what it is if there is a member who gets diagnosed with an illness and the manual physician says he or she is not going to live for more than 12 months, then you can actually request up to 50% or maximum $50,000 amount to be actually paid out to them while they are alive, right? And the event, of course, if something were to happen in the event of death, then whatever is the balance goes to the family members. Few key features on here. Of course, there's no exclusions for war. So if you were to get deployed, or if you have any dangerous occupations, right? If there's reserve members who are, let's say, in paramedics, firefighters, policing, right? Those are dangerous occupations. So with SISIP, you will still be covered. If you go on to do some dangerous sports, right? The bungee jumping, snowboarding, and so on, you will still be covered. And the temporary insurance goes till the age of 75. Going on to the next slide. This is a permanent life insurance, which is called the T100. Now, just want to come back in terms of why you're talking about life insurance, about saving and investing. The reason being is we want to take a look at the value for money, right? So for example, if I had $25 today, if something were to happen to me today, in the event I were to die today, my family would only have $25, right? Whereas if you have a family or you have some family member who's relying on you for income, a better source might be to use that $25 to actually maybe buy a life insurance. Could be a temporary, could be a permanent, depending on what you're looking for. So now you're getting more value for your money, right? So maybe if you need $100,000, I think the one that we have, depending on what age it is, let's say if you're between 25 and 30, for $100,000, it might cost you only $6. So for $6, I can make sure that my family has life insurance coverage in the event I were to die today. That's the value for the money that you're talking about. Hence, you're looking at life insurance aspect first. Make sure the family is well covered financially. And of course, while the person, such an event has not happened, while the person is still alive, enjoying retirement and whatnot, then you still need money to live on. Then we're going to look into the RSP and TFSAs. Coming back in terms of life insurance, the one you're looking at is a T100, which is a permanent insurance. It is a coverage for life, and the premiums don't change. So whatever age that you sign up for, that is going to be the premiums that you will end up paying. So going on to the next slide, you will see that there is various options available. In terms of the age, in terms of when can you sign up for this kind of insurance, is between the ages of 18 to 70. In terms of how much insurance you can possibly get for T100, you can go as low as 25, as high as $100,000. Now, this is a product where there can be a member, spouse, or adult kids, right? So adult kids means who are over the age of 18. If they want to get one for themselves, they definitely can in this product. Depending on the age, gender, and smoking status, the premiums would change. However, whatever age you sign up for, so let's say if you sign up for $25,000 and it costs you $10 a month, let's say, I don't know what age it is, with example, that's the amount that you will end up paying, depending on if you selected the option to pay for life or whether you selected the option to pay for, say, 20 years, right? Going to the next slide, here are the two options you're looking at for paying for the premiums for the T100 coverage for life. One is regular premiums. So regular premiums means the person is going to pay till the person is age 100 or the person who to pass away. So that's regular premiums. The 20 pay option is more popular when you have a younger generation, because for the next 20 years they'll be working anyways. You can offer 20-year pay. So you only pay for 20 years, but the coverage will still be there for life. Right. Any questions before we carry on?
Hey, Mark, I have one sort of question / comment.
Sure.
One thing that I learned from my SISIP financial planner that was really helpful when we were starting our family was we hadn't thought about life insurance for me when, because I wasn't bringing in money when the kids were babies and I was at home. It was something that we hadn't thought about, but one of the really great tips that she gave us was to think about what the cost of living would be if I was out of the equation. So God forbid something happened to me, suddenly there would be additional like a nanny cost or those types of things. And so then we made our life insurance plan with that in mind. So it was an interesting thing to think about, not just income, but also maybe family contributions that offset cost was another consideration.
Definitely, 100%. So that's where when we do the insurance need analysis is where we take a look at what the member's income is, what the spouse income is. We also take a look at the assets and liabilities, and the need analysis actually tells us in terms of, what, based on what's going on in terms of the income levels and so on, what is the recommended for that member and what's the recommended for the spouse.
Yeah. And sort of the cost of living of the whole family picture,
Yes.
right? Yeah, no, it was super helpful when we worked with our planner. Anyways, I just wanted to add that. You go ahead. Thanks.
Sure, no worries. Okay, next one you're looking at is critical illness insurance. Now, this one is called the living benefit because the life insurance is the event of death. This one is in terms of if somebody were to get diagnosed with a critical illness, there's 25 illnesses, but the main ones is, of course, the heart attack, stroke, cancer. So this one pays a lump sum benefit directly to the person who's insured, and the payment amount that you receive is going to be on a tax-free. Right. Going to the next slide. So we covered the life insurance, we covered the critical illness. Now we're talking about in terms of investments, right? Now, two popular accounts that is out there. One is the RSPs and the other is the Tfsa. So first one, in terms of you look at the RSPs, the benefit, of course, is whatever contribution that you were to do in an RSP account, it is going to lower your taxable income. In the other slides, we are going to take a look at what that numbers kind of looks like, the examples, but have an understanding that, let's say, if a person's income is $50,000, and if they were to do a contribution of, let's say, $5,000 in RSP account, now your taxable income is only $45,000, right? Hence, you will probably get a tax refund because your employer was taking taxes out based on 50. Spousal RSP is a very popular one among CF members, especially if you have a spouse who has or who's expected to have lower income in retirement time. So what this means is a higher income spouse can set up a spousal RSP for the lower income spouse. So let's say if I'm a CF member and let's say I have a spouse whose expected income in future in retirement time is going to be is lower than mine, let's say. So what can happen is she can set up a spousal RSPs. I can put money into it. So while during my working years, I can get all the tax benefits, the tax refunds. Whereas in the future, when my spouse were to draw the money out, because she would have lower income, she would be paying taxes based on her tax bracket. So from a family taxation point of view, we'll probably be paying lower taxes as compared to if I would have my income with a pension plus a RSP under my name, then I'll be paying significantly higher taxes. So it's going to be a higher family tax bill. Now, whether spousal RSPs or RSP TFSAs, what works, we definitely, it's going to vary from each family, right? Hence, it's a good idea to, touch base with us. We run through the numbers and then we can say based on your current family scenario, what should be better, whether it's a spousal RSP, whether it's a TFSA, right? But just a general notion of what spousal RSPs are is to lower your family tax bill come retirement time. Martin already talked about in terms of using the money to buy a first house, which is a home buyer's plan. And the other way that you can draw money out on a tax-free basis would be for education purposes, which is a lifelong learning plan. Right. Going on to the next slide. So this is a good slide which kind of shows you, let's say on the left-hand side, you look at a person taxable income of $75,000. And if this person would have done a contribution of say $3,000 into the RSPs, is going to look like the right-hand side, which is $72,000. Now, because this person has done a contribution of $3,000 into the RSPs, he or she would be expecting to get about $944 in tax refunds, right? So if you take a look at how much taxes was deducted based on 75, how much taxes is supposed to be based out of 72, the difference on that one is about the $3,000 reduction in income. Hence, you get a tax refund of $944. Going to the next slide. So this is a projection of, if somebody were to put in $3,000 a year, So $3,000 a year is about $250 a month, right? If somebody did $2,000 a year for 10 years, given a rate of return of say 5%, this shows that, you know what, that person would have somewhere around $39,620, right? So so in total, he or she would have put in from their own pocket, 3,000 times 10 is $30,000. But over a span of 10 years with the investing, compounding, and so on, he or she is going to end up with about $39,000. Go on to the next slide. This one, we're looking at the TFSA, so a tax-free savings account. In this one, the withdrawals are tax-free. And the benefit on this one is it is not any withdrawals that you were to draw money out from it. It is not going to affect any of the federal income benefits, right? The more common is the OAS, GIS, which is the Guaranteed Income Supplement, EI, or if somebody's getting a Canada Child benefit, right? So if you are getting any of these federal income tested products, benefits, any amount that you withdraw from TFSA is not going to affect. As compared to the RSPs though, any amount that you do withdraw, it is going to be added to your income and it will affect all these federal income tested benefits. In the TFSA, other benefit is as long as the money is within the TFSA account, there is going to be no tax consequences, right? Going on to the next slide, it kind of shows you if you were to set up a pre-authorized contributions. So a lot of individuals, when they're doing some kind of budgeting and so on, what they generally do is they have an income line, they'll have a whole list of expenses, whatever is left over, then they try to do some savings on it, right? But that's kind of a self-defeating purpose, because at the end of the day, people don't really look at what's left over, because there's more likely than not there's nothing left over. So what we generally recommend is you have the income line, right under it should be your savings line, right? How much do you want to save? Do you want to save $100? You want to save $200, right? How much do you want to pay yourself? So the reason I say pay yourself is because that $200 or $50, $100, whatever it may be, that amount is going to go into a savings account, whether it's an RSP account, TFSA checking account, whatever account it may be. That account is under your name, right? So you are going to pay yourself first, and then whatever leftover amount is, then you can go and start paying the other expenses that is there, whether it's mortgage, car insurance, and so on, right? So you allocate money first, and then you do the expenses. So in that case, you'll always be saving X amount of dollars first. If you set up pre-authorized contributions, it kind of works really great in the sense that you don't really have to manually think at the end of the month, do I have money saved up or do I don't, right? You already know that you have set up an automatic savings plan and you already know money is already going to this X amount of dollars going to a plan. Going to the next slide. So whether you do the savings within the RSP or TFSA, pre-authorized contributions or automatic contributions is a good way to do it. Now, as you looked at before in the RSPs, if you do a contribution, then when you do your taxes, you will get a refund at the end of the year, right? And when you do get a refund, if the best case scenario is not to just go and use it, best case scenario would be to take this refund money and put into your TFSA, which can actually build up into maybe another retirement account, maybe it's an emergency account, whatever that purpose may be. Going on to the next slide. So this is an example that shows you know what, if you would have done a $3,000 contribution into the RSP account based on your income of $75,000 and you get a refund of $945. If you would have taken that refund and put it into the TFSA account, again, for 10 years, if the money was invested for say 5%, that total amount of $9,450 now at the end of 10 years is looking at about $12,480, right? So you're getting quite a bit of about $3,000 more as compared to what's going out from your own pocket, right? So in the previous one, the 30,000 looked more like 39,000, so you had a gain of about 9,000. In this one, your 9,450 is now 12,480, so you get an additional $3,000, right? So in total, you're looking at about $12,000 in gains, right? Now, these, once again, these are hypothetical numbers. Depending on this, 5% is just an example. Everybody or everyone will have different risk tolerances in terms of how much risk you're willing to take on. So that's something which we discuss with the member or the spouse. And then depending on that, you might see a different return right? Again, a short comparison between what the TFSA and RSPs is. So TFSA can be used for short-term goals because, I mean, when you do draw the money out, there is no tax consequences. RSPs, generally the intent is for retirement savings unless you are using it for buying a first house or going to school, right? In the TFSA, the contributions are made from an after-tax income, whereas in RSPs, when you put money into it, you do get a tax deduction, right? In both of them, the growth is tax-free. In TFSA, when you do draw the money out, it doesn't affect your taxes. However, in the RSPs, when you do draw the money out, every dollar you take out is going to be taxed, right? So it is going to be added to your income for the particular year. Going on to the next slide. So yeah, Martin will carry on from here. Any questions before Martin takes over? Okay, thank you.
All right. Thank you, Mark. So now we'll talk a little bit about fraud and protection. So 2017, total reported dollar loss by victim of identity theft in Canada. Anybody want to take a shot at it? You can use the chat, A, B, or C, 11, 22, or 31 million. Again, these are 2017 numbers, B, B, C. So we got a little bit of everything. So answer is, unfortunately, $31 million. And that keeps going up. I saw some numbers for in the last 5 years for victim identity theft itself. The last 5-year report was, I believe, $94 million. So again, technology, great thing, open up the door for a lot of good things, but it's also open up the door for a lot of bad things. And identity theft is a very popular one, unfortunately, because of technology, so computers, cell phones, and everything. So we do need to be careful. 2006, 4 million North Americans fell victim to identity theft. And again, these numbers just keep going up. Identity fraud, the average, so about just under $1,100 per attack. Phishing attacks, still very popular, and we'll show example of these. Scholarship and loan scams, over 100 million. So again, we're seeing a lot of money disappear, and we, the consumer, pay for that. So we need to be very, very careful and protect ourselves. So most of these examples, I'm sure most of you have seen. So transfer of funds scam, typically, again, these by email, where, asking you to send money, you'll get a great return. It's almost instantaneous. You send us the money, we'll send it right back with, great return. Usually comes out of third world countries. So in this case, Central Bank of Nigeria. Again, these types of things comes in. Sounds too good to be true, because it is. Don't even inquire. It was usually unsolicited. You just got this email from out of nowhere. Just delete these. Same with lottery scams. This one's a UK edition. Often US, UK will see these types of email. Again, unclaimed winnings. All of a sudden, you get the unclaimed winning. So most of these types of scams are attacking our greed sense. And let's be honest, we all have a little bit of greed in us, where if someone's going to offer us free money, we always kind of ask why. Well, again, these cases, they're offering free money. So you send some of your personal information, and from there, they start using your personal information. So again, sounds too good to be true. So be careful with that. Phishing attacks, still very, very popular. Email, starting to see them via text as well now. Usually you'll get an email similar to this saying, maybe your personal information has been compromised. Please click the link below to verify your information. I know I've personally received a lot of these, never from my bank, always from a different bank that I didn't do business with. So it was kind of easy to tell. But a lot of these things used to target, especially the older generation. They were not as used to email and those types of things. They don't necessarily pay as much attention. So if you click that link, it'll bring you to a landing page that looks like a bank page, and you go in, put in your bank card and password, and now you just gave it to them because it's a fake internet page. So again, banks don't send those kinds of emails. If you ever suspect anything, Either log into your account the way you normally do through your app or through your browser. Just don't use any links that are just randomly emailed to you. Nothing good ever comes out of those. Item for sale overpayment scams. Again, depending on where you live, these can be more popular. In this region, we're close to the US border, for example. So we'll see a lot of these types of things on Kijiji, cars, shipping containers, pets, you name it. Normally seems like a great deal. And some of these people are very, very good. I have known a few people that have been caught with these types of scam where they're like, well, I called and they sent me pictures. And so they are good. But as soon as you send that deposit money is where they get you, and then they disappear on you. So always be very careful, especially for online purchases. Google the person's email. If it's a known scam email, it will definitely come up. Just to be safe. Same thing with Googling websites, for either reviews to see if they're legitimate websites. So, you see an advertisement for something being sold online, you Google the website and you see it's just been created less than a month ago. Well, I would be rather skeptic at that point to consider it a valid, website or company. They're probably just a scam where you send payment and then they never ship you anything. So again, it's about paying attention and being careful. Signs of bogus jobs ads. So either for yourself or people again, always being wary with those. This used to be very, very popular on sites like Kijiji and such. So offer considerable pay with next to no duties, promise of wages in cash, which again is not typical. The big giveaway is the next two though. So contains no physical address or contact person. So it's usually a PO box. And then they want your banking information or ask you to set up a new bank account to test a wire transfer. Now, the reason they ask to set up a new bank account, because if you ask someone for their banking information, that seems risky. Versus if we say, well, set up a new bank account and then send us that information, it feels less risky. They also count on people having good banking information, which means that you might have overdraft, didn't think about that right off the bat. They will deposit $1 into your bank account to make sure that the banking information works, and then they'll withdraw everything that they can and potentially do some fake deposits to again withdraw the funds, and then you're the one stuck with that. So when it comes to giving any personal information for employment, again, you never give personal information, certainly not banking information until after you've been hired, certainly not at the applying process. So it's really about protecting yourself and it's protecting your information. So the first line, it says, don't share your personal information. That sounds nice, but most people are not aware of what is personal information versus what is public information. So I'll tell you what is public information about us here in Canada. Name, address, phone number is all considered public information. It's something anyone can look up through phone book, online and such. So that is considered public information. It's not protected. Email is actually considered personal information unless it is put on a business card and used for business purpose. So if you have an email on a business card, now it becomes public information. So name, address, phone number, potentially email, that is public information about yourself. That's it. Everything else about you is personal information. And again, we've certainly evolved into, a social media type population between everything that's out there. A lot of us are very, very bad at putting a lot of our personal information online. Facebook's a perfect example. Now, some people only have a few friends. They're real people they know, family and such, but a lot of people will have thousands of friends and they don't know half of these people, right? So I can find your name because it's public. I can probably find your address. So again, because it's public. Now I'm on your Facebook and I have your full date of birth showing. Well, I've got everything I need to apply for credit. Name, address, date of birth. I don't need your social. I can make up the rest of the information. So that is probably the most common way people steal identity is using social media. So again, if you're going to put your birthday up, maybe not put the year, just limit it to the day and month, for example. So again, to limit some of that information. A lot of posts we see on social media are actually posts to try to gather data from people, and they make it sound like the cute little things, oh, what was your first car, or what was your first pet's name, and what's your favorite memory from school, and things like that, which people love to answer, right? Because it sounds very innocent. But if you actually think about it, a lot of these questions are the security questions that most banks and financial places ask as security questions. What was the name of your first pet? Oh yeah, that's what people put down. So now social media, people are using these types of, fun quiz to actually gather data off of people. So again, you got to be very careful when you play along with these things and you answer to think, is this information actually, valid for something? Because again, it's all about data gathering. So we do need to be very, very careful. So again, destroying any documents with personal information, being careful, wallet, purses, and such. Don't carry ID you don't need. So social insurance number, for example, is not a number that we need on a regular basis. The only time we need to give our social insurance number is when we are hired for a job for tax purpose, and when we file our taxes, or if we apply for any government program. Then we have to give our social. Outside of that, people are allowed to ask us for our social insurance number, but you are also allowed to decline giving it. Okay, there is no obligation. And our credit files are all tracked through social insurance number. Absolutely. But again, when you're applying for credit, you do not have to give that number. Now, if you have good credit, you give it. It certainly guarantees or helps make sure that they get your file to get your proper information, and might make the credit application a little bit easier. But again, if you don't feel comfortable giving it, you absolutely do not have to. And they can still pull a credit file without social insurance number. But the only time, like I said, that you need to give it is when you are hired for a job and when you file your taxes, or if you are applying for any government program. Outside of that, you have every right to refuse giving that number, and you cannot be refused service for doing so. And limit the number of credit cards you hold. Again, having 5, 6, 7 credit cards typically doesn't really benefit you in any way. If anything, it just puts you more at risk. So now if you lose your wallet, you've got 4 or 5 banks to call. That means they got that much more credit to play with. So again, typically no need to have that much. Again, we always suggest to check your credit report once a year. It used to be complicated. You had to write into both credit bureaus and request a copy to be sent, and then the copy you receive, if you'd never looked at a credit file before, most people can't make heads or tail with it. So checking it didn't give you a whole lot of benefit because people didn't know how to read them. Nowadays, again, one of the benefit of technology, so we had talked in our last presentation about credit, about borrowwell.com and Credit Karma. Again, legitimate sites where you can get access to your credit file anytime you want. Again, it's just about verifying the information, and it also making sure that what's there is yours. If something shows up that is not yours, you can get it corrected. And again, being part of the CAF world, there's a potential where you might be moving around a lot. So if you're at that stage where you're moving quite a bit, we always forget to change a piece of address on something. So that means someone's getting our mail for something. I mean, I've been in this home now for a little over 5 years, and I'm still getting mail from the previous owners, right? So that happens quite a bit. So that's where, if someone moves into an apartment that's not necessarily as good with things, that's where the risk can happen. Again, deleting emails that ask for personal information, just don't respond, just get rid of those things, keeping firewalls up to date. Again, keeping passwords safe. Unfortunately, again, in this day and age, we've got passwords for everything, so it can get a little bit tricky. But again, just making sure that it's not something people could guess easily. Not giving telemarketers any personal information, especially when they call you saying that they're calling on behalf of maybe a company you do service with. And now they want you to confirm, your name, your address, your phone number, your date of birth, and all of that. It's like, well, they should have this information already. So again, try not to give people too much information. Again, destroying documents. And again, the real key here is be skeptical. It is unfortunately the world we live in today for a lot of things. It's about being skeptical. If something sounds too good to be true, it usually is. Question it. And the same tools that opened up the door for bad things are the same tools we can use to help protect ourselves. Google things, look it up. Just see what comes up to make sure that you get that confidence level that what you're looking at looks real. I can tell you from personal experience, I have no problem saying it, Facebook is probably the worst for fake ads of companies. A lot of the stuff that is for sale on there are scams. And I've tried one once. I thought, this looks like a good deal, pretty cheap. I did it, ordered it, used my credit card. It was a scam. Like I never got anything. Now, thankfully, because I put it on my credit card, you get fraud protection. So I was able to dispute the charge and get my money back. But it's still a process to go through. So just be very, very careful. If you ever suspect any type of identity theft or fraud, again, contact your bank just to make sure that everything's okay there. It's a good idea to contact and notify both credit bureaus, especially for identity theft, because they can then add additional security on your file. So if anyone tries to use your information, that should stop them. And then the last two, Canadian Anti-Fraud Center and local police. Good idea to contact those two groups to let them know. The reality is they're not going to do a whole lot for you. But doing this is what I call being a good neighbor. Canadian Anti-Fraud Center gathers all the data for fraud. So again, we're able to educate the public on what's happening and the type of frauds that are out there. And it's the same thing with the local police. Again, they're able to advertise and let people know in the region what kind of fraud is happening. Because a lot of these types of fraud, they tend to hit regions and they'll hit the region until they can't get anything out of it, then they'll move on to another area. So letting these two organizations know just lets your neighbors know what's happening, and hopefully somebody else doesn't get caught. So that's the generic idea here about fraud. I again will put my information up on the screen. Again, feel free to contact questions, anything. Absolutely, that's what we're here for. More than happy to assist. And thank you for joining us this evening. And we will open the floor for questions.
Thank you so much, Martin. I really appreciate you finishing off our series tonight and our special guest, Mark Lee, with Investing in Savings. I am just going to sign off now for the MFRC and finish our recording so that people can ask their questions. Thanks so much for joining us, guys.